Welcome everyone to Vested Interest. This is Shane back again from the Stock Pick of the Day video. It is Thursday, October 17th. We are going to take a look at one out of the healthcare sector today, Elevance Health. Now, before we get too far in the video, if you could do me a big favor, hit that thumbs up button down below if you find any value in the content. Make sure you're subscribed to the channel. Join us on this journey to financial freedom. Join the Vested Interest community. Click that notification bell so you're notified whenever we put out any new content. I do this Stock Pick of the Day series Monday through Thursday whenever the market is open. I also take suggestions from viewers and subscribers. So if you have a company like Elevance that you would like me to cover in the Stock Pick of the Day series, go ahead and drop it down in the comment section below. I'll work it in the rotation. And let me know what you think of the videos in the comment section down below. And one last request, watch time is one of the YouTube algorithms that they use to spread the video. So if you could watch the videos to the end, I really would appreciate it. And a special thank you to all the subscribers out there. You guys are awesome. The channel continues to grow because of people like you. And one last time, if you haven't joined the community, hit that subscribe button. Come on out of the shadows. When I look at my data from who's viewing the channel, a lot of you out there are not subscribed. So I'm assuming you enjoy the channel, you enjoy the videos. So hit that subscribe button, help me out. It doesn't cost you a thing but a couple seconds of your time. It's free. I don't have any paid Patreon or anything like that that you have to go to, or any other sites or any merchandise I'm trying to sell you. Maybe some merchandise in the future, but definitely not any sites or any paid Patreon or anything like that. Now, this is the Vested Interest Stock Screener. This is how we're going to go through the video. It's also how I look at a company on a high level to see if I'm interested in adding it to my watch list. Just because it makes it on my watch list does not mean I am investing. It means I want to do more of a deep dive into the company, look at its financials, balance sheets, income statements. I'm looking at stuff like debt to equity ratios. Are their margins expanding? Is their revenue expanding? Are they paying down debts? Do they have more assets over liabilities? So if they had to sell off some assets, they could. Are they buying back shares versus putting more shares out into the market and diluting you as a shareholder? So we'll run through this screener. We'll see how it stacks up at the end. And back to Elevance Health. Check them out at their homepage, www.elevancehealth.com. That's www.elevancehealth.com. That is their homepage where I pull this information from. Who we are, fueled by our bold purpose to improve the health of humanity, we are transforming from a traditional health benefits organization into a lifetime trusted health partner. Our nearly 100,000 associates serve approximately 100 million people at every stage of health. We address a full range of needs with an integrated whole health approach powered by industry-leading capabilities and a digital platform for health. Well, that really sounds great. They said health a lot. They're an insurance company, right? They're doing healthcare insurance, life policies, life care policies, Medicare and Medicaid, and these are the three arms that they have. Carelon, Anthem, which is a branch of Blue Cross and Blue Shield. Actually, Elevance itself is a branch of Blue Cross and Blue Shield, and I may or may not work for Blue Cross and Blue Shield here in Michigan. Hint, hint, wink, wink. And WellPoint is their third one. So, right, the Carelon focuses on serving the most complex challenges in healthcare. Our solutions connect people with technology, data, and expertise. So that's the healthcare arm. Anthem, through its affiliates, Elevance Health, offers a comprehensive suite of commercial Medicare and Medicaid. So they're looking at older or people who need Medicare and Medicaid plans specifically. And WellPoint comprises affiliated health plans and specialty companies. I believe this is more along the lines of long-term care, right? You might be elderly care, might be life insurance, that sort of thing. You could, again, go to each one of these on their webpage. You'd be able to find out a little bit more about them. But overall, they are a insurance company with several branches underneath their umbrella. Under the Elevance Health name are these three. Now, the reason we are taking a look at them, huge drop on the day, down 10.33%. We are talking about Elevance Health, ticker ELV, out of the healthcare sector. Closed out the day at $445.63. Looks like they're up slightly in the after hours. 52-week range as low as $397.98, as high as $567.26. They are actually within 15% of their 52-week low currently with this big drop. Market cap of $103.336 billion, a beta of 0.83, so they are slightly less volatile than the overall market. Price earnings ratio, PE ratio, is in pretty good shape, $15.59 per share. EPS is very high, $28.58. It's not very often you see earnings per share higher than the price earnings, but in this case, it's significantly higher, almost twice as much. That's very nice to see. Earnings date, October 17th. So tune back in. Actually, it was today. So I'm assuming something in their earnings is what drove this big drop here. Or projection for their future outlook may have been downgraded or something along those lines. But I would check out their earnings and see what's going on with their report out. Forward dividend is $6.52. They are a quarterly payer. You can divide by 4, though we will see that here in a little bit later in the video. Starting dividend yield on this one is low at 1.31%. Ex-dividend date was September 10th. They did pay out on the 25th, so kudos to those of you who owned this one and got your dividends last month. You would get dividends on the next payout, though you're going to have to wait a few months for that if you were to buy them now. One-year target estimate, $603.17, which would be a new 52-week high, and that represents significant upside from where they currently sit. I think it's about 20-25% upside there. I'd have to do the math, but that's a pretty nice upside for this one if that was to come to fruition. That's according to the Yahoo Finance. Now, jumping over to the right, we're going to take a look at dividend yield theory to see if this one is potentially presenting any undervaluation. To do that, we look at their 5-year dividend yield average of 1.14%. We compare it to their current 1.31%, or over here where it says forward 1.31%. That's the same number. Since it is higher, their current is higher than their 5-year average. That speaks to undervaluation. These numbers are inversely correlated. If it's higher than their 5-year average, that speaks to undervaluation. If this was lower, that would speak to overvaluation. Now, payout ratio is another metric I look at. I like under 75% payout. They're sitting at 21.78%, so that's very good. Their dividend payment is not in jeopardy of being cut. They can still increase it over time, and they still have plenty of free cash flow to pay down debt, make acquisitions, reinvest back into the company, or increase those dividends over time. Dropping down, we're going to look at free cash flow. I like growing free cash flow over time. Typically, if a company has growing free cash flow, they have growing dividends to match. Going back to 2020 here, or 2021, I mean, you can see $7.2 billion in free cash flow. 2022 looks like they're actually down slightly to $7.24 billion. 2023 down more to $6.7 billion, and the trailing 12 months $820 million. Though we're gonna have to wait for the last quarter to see how they shake out, but that looks like a big drop. So overall, it actually looks like, well, maybe not quite decrease in free cash flow, because if you look at the repurchase of shares, they were at 1.9 billion here in 2021, jumped that up in 2022 to 2.3 billion in repurchase of shares. So even though their free cash flow went down slightly, with the increase in the repurchase of shares, that more than accounts for it. I'd have to do the math to confirm, but it looks like that would account for it. And possibly from 2.3 to 2.6, maybe that accounts for it in 2023. But so far, trailing 12 months does not look like, if it holds up here at 8 billion, excuse me, 820 million, or even if it got over to $1 billion, if it doesn't hit almost 7 billion here, their free cash flow is going to go down. So I'm saying they are not, because this trailing 12 months is very low, not even close to where they were in 2023. So I'm going to say no to growing free cash flow on this one. Now, jumping over to stockanalysis.com, this is another source I go to for information. You pick any sources that you like. I just recommend more than one so you can make sure the information you're getting is accurate and up to date. It's a way to back check, right? 2, if not 3 sources, so you can just verify the information is accurate. Now, they do have 14 analysts that have taken a look at this. They call it a strong buy. They have a low estimate of they have a low estimate of $530, which would represent a 6.65% increase from where it currently sits. Average estimate of $605.07 would represent a 21.75% increase from where it currently sits. And if it happened to hit their high of $649, that would represent a 30.59% increase. And that average estimate is pretty close to what we saw with Yahoo Finance on the previous page. So yeah, it's about a 20% increase, what Yahoo Finance was estimating. But if it, like I said, if it happened to hit their high 649, 30.59% increase. The thing to note here is that all of their estimates are actually significantly higher than where it currently sits. Now, jumping into statistics, I like to look at return on equity and return on invested capital and see how well a company is using its capital to reinvest back into itself, whether it's making acquisitions, building out new branches in this case because it's an insurance company, buying back shares, that sort of thing. And return on equity and return on invested capital are the two metrics that I look for. I like 10% or better for both. You can see here return on equity is sitting at 15.5%, so that's above the 10% I like. Return on invested capital is just a bit low at 9.75%, so it doesn't quite get there. No check there. EPS growth forecasted over the next 5 years is at 18.28%. I like 5% or better there, so that would get a check. All right, let's jump over to dividend history and wrap this one up. They are a quarterly payer, as we mentioned before. Payout ratio very low, 22.9%. Again, I like under 75%. Dividend growth, double digits, 11.36% dividend growth. I like that. I like to see double-digit dividend growth, especially with such a low payout ratio, and especially if they maintain that. 13 years of dividend growth, buyback yield of 1.98% positive. You want buyback yield to be positive. That means they're doing it efficiently, not buying back shares when it's overvalued. Shareholder yield of 3.46%. You want that to be positive as well. Now, they do pay out on the March, June, September, December timeframe. Most companies do. Going back to March 2022 here, you can see $1.28. Raised it up March 2023 to $1.48. Raised it up again March 2024, most recent, to $1.63. That's where it remains, and I would anticipate if they're going to maintain these raises here, which looks like about 20 cents-ish, not quite 20 cents there, but pretty close to 20 cents a pop here, that we'll see another raise in, when was it? March. Was it March? Yep, March. We'll see another raise here March 2025. All right, let's jump through the screener here and see how this one stacks up. Understand the business. That's where we start. Check there. Growing free cash flow. No, we had the down year. It looked like in 2023, maybe even in 2024 as well. Growing dividend. Yes, there's a check there. Double-digit growth. I like that. Dividend payout ratio is low, under 75%. It's under 30%, so very low, under 25%. Very low. Dividend yield theory says it's potentially undervalued right now. It is within 15% of a 52-week low, so check there. Return on invested capital and return on equity. Return on invested capital was a little low. Return on equity met the metric, but no check because they both have to meet it. And earnings per share growth at 18%, check there. So we're looking at 1, 2, 3, 4, 5, 6 out of 8. This one will go on my watch list. I am not really looking for anything in the healthcare sector right now, but this one does look interesting. It might be worth taking a look and adding to your watch list. Let me know what you think in the comment section down below. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So again, if you have a suggestion you'd like me to cover in the Stock Pick of the Day series, go ahead and drop the name of the business down below, and I'll work into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great week. This is the last Stock Pick of the Day video for the week. Tune back in on Sunday. I'll be putting out the portfolio update. But have a great week. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing in your educational and insurance purposes. Investing involves risk. You can't lose money. Never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.